Welcome back to our session for chapter number 8. This is our last lecture for chapter number 8, Standard Cost System. This is the topic we'll see in this lecture, that what is a standard cost system. Now basically what are the standards? We need to understand first standard. Sometimes we call it a benchmark, or sometimes we call it the expected performance. That is a standard. For example, let's say as a student, we know that if you want to graduate, the standard is that you need to have a GPA of 2, for example. So that is a standard for graduation, right? Now similarly, same thing here in managerial accounting, we have a standard cost system. Basically it helps manager plan and establish a benchmark against which actual performance can be judged and compared. Now we know that in any organization, any business organization, there are a lot of operations, activities going on, and if you are a manager of a company and you want to see which areas of operation we need to spend time, instead of looking at each and every detail, what we can do is we can look at only certain areas of exceptions, right? Means that this, not looking at all the numbers, something with an exception, those areas where we have small changes we can ignore, but something which is not common, we can focus on that one. That is what we call it, or that type of management, we call it management by exception, right? So we in management focus only on certain aspects which need attention. Now how we can pay attention? We can set a standards. If anyone who is paying or who is achieving standard, we don't have to look at those performance. I can give you an example. As a student, for example, management want to see a student whose GPA is less than 2. Now instead of looking at all students' GPA and then discussing each and every GPA is not a wise idea. It will waste a time. So what college management, for example, can do is, okay, they can say, okay, how about the performance of those students whose GPA is less than 2? So basically we set a standard and then you compare. Similarly, management maybe want to see the students who are high achiever, why they are achieving high performance, for example, or how they should be rewarded. Let's say they say, okay, anyone having a GPA of more than 3.7, right? Again, in order to select those high achievers, let's say you set a standard of 3.7, for example. So anyone having more than that GPA, you can focus or you can pay attention. Same thing in organizations, we set standards, right? So this is what we call it management by exception principle, right? So basically by reviewing performance reports that shows difference between actual and standard cost, right? What was the actual cost, what was the standard cost, and see which item shows a significant variance, right? The areas which need small variation, we can ignore it. Standard cost systems. So I'll just summarize what I have just said on this slide. A standard represents amount, a price, right? That a selling price should be 70 as an example, right? And we should sell all items by a price of 70 as an example. This is a standard. Why we sell it actual, why we give a discount, for example, at the end to increase sales, that is a separate area. We'll see it later on. So standard could be a price, cost. What should be the labor cost as an example during the last year? This is the standard. You give a standard and then you compare that cost with actual cost. standard is just like it's the same concept of budgeting. You have a cost in the beginning, at the end you compare that cost with the actual cost, or how much quantity we should produce and sell. Then at the end of a year you compare it with the actual. Now accountant, engineer, or purchasing agents or production manager basically combine their efforts to set standards. Now those standards that encourage or improve future production. Now standards can be ideal standards. For example, ideal standards means that it's a flawless performance, that for example every student must have a GPA of 3, or all students must have at least A in a course, for example. This is an ideal standard, but we know that in a normal circumstances it is not possible that we can achieve those ideal standards. So that's why someone come up say, no, we need to have practical standards, right? Practical standards means what employees can achieve. Okay, those are what we can say practical standards that someone can attain, right? This is what we can do in standard setting. Or sometimes a standard setter can set a very lax standards, means easy to achieve goals. That okay, right? Now easy to achieve goals because employee want to show their performance, right, that they achieve a standard. So that's why we have 3 type of issues in standard setting: ideal standards, practical standards, and lax standards. You can review these things on page number 362 in your book, right? Now ideal standards, that what should be the cost under best circumstances. This is what let's say in a real life an engineer should say, okay, we should use an ideal standards. There should not be any material waste, for example, or there should not be any labor inefficiencies because of a machine downtime, right? Or downtime machine, maybe there is a breakup of a machine or maintenance. So meeting these ideal standard is not possible, right? So but maybe a managerial accountant may say, okay, that we can set some practical standards, right? That an average worker can perform those standards, and if they perform diligently, means honestly, those standards would be achieved. So standards can be ideal or it can be practical standards, right? Now why we need to have the standards? Basically it helps managers plan and establish the benchmarks against which actual performance can be judged. This is what we call it management by exception. So focusing on material differences between actual and expected results. We only focus something which is material, not a small amount, and we need to spend on a time that why few halalas have been spent more or less. So it's not important. Instead, we must focus on standards which are material in nature. And remember, in accounting, we have a very important concept. Materiality is a very important concept in financial accounting as well as managerial accounting. Now, which variance we must select to investigate, right? What do we mean by variance, right? Let's say the standard is to have a GPA of 3 and someone has a GPA of 2.98, right? So now this one is not that material, it's approximately, it's the same thing, right? So we should not spend our time on looking at this variance. What we can do is we can look at a variance which can significantly influence the management decisions, right? Now those variance, remember these variance can be favorable or unfavorable. Remember we already discussed, right? When it is a favorable, when it is an unfavorable. Also we can look at their frequency. Of course, it's maybe cost is 1,000, for example. There is a variation that we spend more than 1,000 real more than the budget. But if it's keep on happening every month, same 1,000, maybe for 1 month it's not important, but if it is happening every month, the frequency, same difference, 1,000, 1,000 for every year, that the variance is 1,000, then it means there is something wrong, right? We need to investigate. This is what we call it management by exceptions. Then management need to focus into more. Why it is happening? What are the reasons? Is it something problem with the production, or there is something wrong with the material, or wrong with the machines that we are wasting a lot of material? So could be many reasons which we need to investigate. Then who has the capacity to control that variance also? Who has a control? Let's say one of the fixed cost variance is rent cost, for example, and suddenly rent cost has been increased. Do we need to penalize someone? Because no one has the control over this one, because this is external, right? Or just now due to earthquake or due to any unexpected epidemic, just for example, right now we have a big issue about a coronavirus. So at the end of a year, if for example, if a management want to see that there is a variation from the budget, so again you have to see what is the capacity to control that variance, right? So if no one has a control over that variance, it's just a waste of time. Spending, investigating, time of the management will be wasted, right? And then last about variance is the characteristics, right? What are the characteristics of the variance, right? For example, sometimes maybe there is a variance and there can be a management abuse. For example, I can give you an example. In order to control a cost, right, a manager can, let's say, avoid maintenance cost, for example, right, or he can avoid research and development cost or advertising cost. But in order to control a cost, right, he can have less variance, or he can control a variance, but a company may have a long-term effect of this one on the company's profitability. So that's why it is very important for a management that they must understand what are the variances and how these variances are associated with different items. They need to carefully analyze. Okay, so we'll move to the next slide. This is the example of what we are studying in this chapter, the same one. We have that Melrose manufacturing company to calculate material manufacturing variances. This is the same one given on flexible budget on page number 357, right? If you look at there, it is we have all the information. If you look at variable material cost per unit standard is 12, right? And then how much was actually spent is 11.78. So in this case, we know from here that the variance here is favorable because we spent less than the budgeted one. But here when we look at a variable cost variance, we can see here that actually we spent 17.25, which is more than the standard. So this variance is unfavorable. Similarly, for overhead cost, actuals we spent more than the standard. So if you look at a total variable cost, actual versus standard, here we can see that total variable manufacturing cost is per unit cost is unfavorable variance because we spent more than the standard. Now if you want to calculate a total cost, multiply by 19,000, so we can get a total variable cost. This is the fixed cost, so this is what we have, our total manufacturing cost. We know that total manufacturing cost is three elements, those material, labor, overhead. This is our variable cost. This is our fixed cost. If we add fixed and variable together, this is our total manufacturing cost. So from here we can see that the total cost, total manufacturing cost has unfavorable variance. We spent more than what we were supposed to spend. Right, so this is our actual production volume. Now we'll see, first we will just review at this first one, the material variance. What are the reasons? Why we have, what was the reason for this variance? So remember, you can see here material cost, right? Or if you go and look back to material price variance, which is 4,180 on exhibit 8.3, same one, right? It's very important. Just go back, if you have a book, look at exhibit 8.3, right? So total this one for variable material variance was 4,180, which was favorable. Now we'll see what was the reason why we had a variations, right? What was the reason for a variance? Now if you look at this additional information, this is given in a question as well, that we must use 6 pounds of material to produce 1 unit. So what is the total quantity of a material we use is 114,000. This is the quantity, remember, it's not price or dollars, right? And actually how much we have used for one product is this one. Now from this one we can see, now we are looking at a variance in a material cost, right? Now why we have a variation? Maybe we used more material. This could be one reason, right? Material, it could be the one reason is because of a usage, or maybe someone from a purchasing department, they purchased an expensive material as well. So could be any reason. So this is what we'll see, that this reason, this variance, what are the reason for this variance? Who is responsible? Is it production manager that he wasted or used more material? Or is it a purchasing manager who purchased an expensive material, for example, or he did not negotiate well with the suppliers, right? So this is what we will see next. Now if you look at next slide here, which is a material price and usage variance, why we had a variance in a material cost, right? Now remember, we are going into more detail. We are breaking down those variances, right? Variance of material. Similarly, later on you'll see variance of labor cost, variance of overhead cost, variance of fixed cost. These are the 4 basic elements in any manufacturing cost, right? One is material, one is labor, overhead, and then fixed cost, right? So first one, we will look at this one, material price and usage variance. There is a formula which is there. You can use it or you can understand this one to solve it, right? These rules are given also in your book on page number 365, exhibit 8.4. You can see here. Now I'll explain here. See, this one is our basically a flexible budget variance. That what is the actual cost? Actual cost means, how do we calculate this column? Actual quantity used. What is the actual quantity used? We know it is 19,000 for our example, times the actual price of a material per pound. I can go back here. See, this is the actual price of the material, 6.2. What should be the standard is 6. This is given, right? So actual quantity used times actual price per pound. So, and this last column here, this is our static budget, the first one from the beginning in this chapter. Same concept, we call it a static budget. This is from there. So standard quantity, how much standard we must use? Standard quantity means this one here, standard quantity, right? This one, 6 for example. This is the standard times the standard price, right? and this one in the middle here is, we call it a variance divided column to calculate a variance. So this is basically actual quantity used times what should be the standard price. Actual quantity is 19,000, standard price was 6, let's say in this case, or sorry, for a material it is per pound price is given in our question. Okay, so these prices are given. If you look at on page number 365, what is the price per pound, right, for a material. So what is the price per pound is 1.90 is given on in the book, page number 365. These informations were given, right. It was not shown on the previous slide, but these information are given. Sorry for any misconfusion. So how much actual quantity of a material, right, how much material is 117,800. From here you can see this is the actual material they have used, this one here, this number, sorry, this is the amount of quantity of a material times its price, standard material use times its price, this one. I'll go back. So now 1.90 is the actual price. So this is what the actual cost of a material. Now this one actual quantity based on standard price should have been. So if you look at here, that our actual cost is 223,000 as compared to our flexible budget, which was adjusted for actual quantity 235,000. So actually we paid less. You can see from here that this material means we call it a price variance in terms of price. See, it is same, quantity is same, the only difference is the price, that at the price at which we purchase the material was less than what was the standard, so we pay less. So we have a favorable material price variance of 11,780. Clear? Now if you look at a last column here, which is a standard quantity, again if you go back here, standard quantity 114,000, this one, times the standard price is 228. Now for usage variance, how much actually material we have, you can see here, this is a price, standard price is same here, you can see here. So what we are checking here, not the price, we are checking about the quantity, the usage quantity, actual quantity, and here is the standard quantity, right. We used here more quantity actually. Now if someone is breaking the variance, initially it was favorable, but if you break, you can see here, okay, that we, in terms of price we have a favorable variance, but in terms of usage they use more material, right. They actually used 117,800, but they should have used this one. So it is unfavorable. Again, if you are a manager, they must investigate what are the reason. Maybe here they purchased a cheap material and it was difficult for production manager and to use that material on time or efficiently, that's why they use more material than the standard, or could be any reason. So but again, from this information, in a management, in performance evaluation, you can look at it. This is the purpose for performance evaluation. You can compare and dig deep what happens. You can discuss with the production manager this variance, for example a purchasing manager and production manager. You can call a meeting with management accountant, with production manager, with engineer, with purchasing manager. You can see and see why it is the reason why we have an unfavorable variance here and why we have a favorable variance here, right. So now total variance, we know what is the total variance here, which we need to calculate, but we already seen it in previous exhibit 10.3. If you have it in front of you, it was 4,180, which is the difference between these two. We don't have to worry about remember negative sign here, what to minus what. If one is favorable, other is unfavorable, you can calculate a difference. if I look at here, favorable is more than unfavorable, so my answer should be favorable, overall variance together. If I minus this from this one, I'll have answer 11,780 minus 7,600, it will be a favorable variance. Okay, if unfavorable is more than favorable, then you will have a unfavorable variance, but in this case we have anyhow unfavorable variance. This one. So this is how we calculate a variance. This is very important. You can memorize it, you can practice it, right? Also the same is given in your book as well. On this next slide, the same thing what I have done before. This is shown. This is a price variance, this is a usage variance, usage of a material, usage, price, actual price minus standard. This is usage, actual quantity minus standard, times standard price. Here is times the quantity, right? So overall we have 7,600 as an overall 7,600 unfavorable variance, and for favorable variance this one. So together one is favorable and is another favorable. You take a difference and it should be same what we have in the previous slide. Now who is responsible for these variances? Production manager is saying I'm not responsible, right, for this unfavorable material quantity variance, because production manager or a purchasing manager, you purchase inferior quality, means not a good material, so my labor has to use more of it, so I'm not responsible. I have used more material because you gave me or you purchased a low quality material. But purchasing manager, he may say, oh no, because you are inefficient, you are poor scheduling, sometimes need me to make a rush order material at a higher price, and this is the reason, because I have an unfavorable price variance. In reality, it is very difficult to put a blame on or we can say the responsibility for the material variance. Who is responsible, right? Who is responsible? This is not easy, right? So management need to look at this information very carefully if they want to evaluate those performances. Again, you can read more on page number 367 about this responsibility for a material variance. Next one, a labor variance. Now similarly for labor variance, we have some information given in this question for same thing, that price for labor cost for 1 hour is 11.50, the actual one, and this was the budget or the standard one. What is the time they need to spend in order to produce a 1 unit of product? 1.5 hours they need to spend. So 1.5 times 11.5, this is the cost per unit to produce. This was the actual cost. What was the standard? It was 16.80, 12 multiplied by 1.4. These information are given. So again you can see from here, that the cost of a labor actual cost is higher than the standard one. So in this case we have very clearly unfavorable labor price variance. This is what we call it, right? But if you look at a production time, or means the hours labor spent, actual 19,000 times 1.5, so 28,500, and 26,600 is the standard. So also we spent more times than the budget, right? So now we have in a labor also we have two types of variances, right? A labor usage variance. This is a labor usage, and this one is a labor price variance. These are the two types of variance. Labor price, we paid them higher than the standard, and here we also used more than the standard. So it means we have a unfavorable labor price variance, and we have an unfavorable labor usage variance. Now how to calculate? Same method here. This is the actual column. This one here is the standard or our static budget column. Actual hours used 28,500. If you go back from here, this one 28,500 multiply by the cost of for per hour is given 11.50 on page number 368. These prices were given. So this is the actual cost of the labor. This was the standard cost of the actual hours times the standard price of the labor. So this is labor price variance, which is so now we need to compare here. Actual cost is 327,750, and at actual hours this should have been 342,000. So we paid less amount. So it is a labor price variance. So that's why I'll go back here. So again, if we look at this one, that was my sometimes a misunderstanding. For example, here we cannot determine from here whether it's a labor price variance is favorable or unfavorable unless we go to next slide here and adjust it to the actual one. You can see here, this is the actual, this is the actual price, this is the standard price. So we pay less, when we pay less, if you pay less, it is a favorable variance. Now for this one here, we can check also for usage. We should have this is our standard, but we actually use this one. So we can see here that for the usage it has an unfavorable variance. Unfavorable variance for usage and favorable for variance for labor. Again, you can check it. Go back to exhibit 8.3. You can see there a total variance there. So a total variance, if you calculate now, one is favorable and next is unfavorable. So we'll have a difference from them, and it will be an unfavorable because unfavorable is more than the favorable. So now you can see here the total variance is 8,550, which is unfavorable. Now we have broken down in this one our variance into price variance and into usage variance. In price variance we paid less, but for usage variance we paid more. We used more of the labor hours to produce same number of products. So that's why overall our variance is this one. Now who is responsible? This one, usage is production manager, and also this one may be the supervisor or the one for budgeting, whoever is paying them. So these are the two different variants. You can analyze and see who is responsible for this one, who is responsible for this one. You can discuss with them in management accounting, right? This is the purpose why we have these variances. This is the same, again using a formula you can calculate this one also. It is exactly the same method. Now again, who is responsible for this labor variance? Maybe production manager is normally responsible for this variance, because production manager is the one who can influence the skill levels of those who are responsible or assigned to different work tasks. Maybe he assigned inexperienced labor to certain tasks, so that's why they took more time. Or maybe level of motivation was not high, or quality of a production supervisor was not good, or the training provided to employees were not good. So could be many reasons. So in management accounting, in order to evaluate a performance of production manager, you can look at many factors, what happened to this variance, and then you can take different actions. This is the purpose of management accounting. Now again, who is going to be blamed? Production manager say, no, I'm not responsible, right? Why? Because it is from the purchasing manager. He purchased the cheap material, so it took more time, right? Now why purchasing manager saying no, because it took more time to process the material, because maintenance department did not maintain those equipment well. So there was a lot of machine breakups, or suddenly the machine stopped working. So maybe it is a responsibility of a maintenance department. So in reality, it is not easy to put a blame on someone. So that's why it's very difficult for management to make a decision. But again, at the end, it is their job to evaluate these variance, and this is the purpose, that they have to spend their time on exceptions, right? That we have to spend time on exception to find out what are the reasons for the variance. Last one about overhead variance. Similarly, we can calculate an overhead variance, which is actual cost minus standard cost times actual units. To calculate a variable overhead variance is straightforward. Actual cost minus standard cost, right? This is given in questions as well. And then you can calculate who is responsible, and here we can see that it is unfavorable 2850 in the question. It will be given. So actual cost is 5.75 minus 5.60. If you don't know from where this number came, right, you can go back to the previous pages. I'll give you the page number from where we get this number. It was on page number 357. Page 357. Variable overhead cost is given, right? Variable overhead cost 5.60, which is a standard cost 5.60. This one, actual cost for overhead is 5.7, actual minus variable times actual units. So you get, because you can see from here, actual cost is more than the standard cost. So of course, cost means when you spend high, it is unfavorable. So this overhead, but the variable overhead variance is unfavorable. This is just a summary of what we have done before. Similarly, variable general selling and admin expenses can also have a price and usage variance. Similarly, for general selling and administrative expenses are also subject to variance analysis. Why? We have more than what was the standard or less than the standard, or this is for all variances. This is a summary of all, right? So how to calculate a price variance, which is actual price minus standard price times actual quantity. For usage, actual quantity minus standard quantity times standard price. This is summary for any type of a variance, right? So this is end of our chapter. Try to practice and solve the questions. Very important to have a good practice. It's not difficult. What I suggest you is to solve a problem on page number 372, a self-study problem. It's very important. I'll give you more assignments as well. After this lecture, you will get an email with the assignments. It will be there, but very important. Practice chapter number, I'll just mention here. So just for your reference here, practice review problem on page number, practice review problem on page number 372. So very important, just practice. So practice this review problem on page number 372. Solution is already given as well, so it is very important. Just try to practice. Without practice, these questions will be difficult, so please try to practice this question. So that's it. This is end of our chapter. next slide will be for new chapter. So now I'm going to end my lecture. If you have any question, just send me an email for any issue you have, and best of luck. See you soon, inshallah.